This is Covered Calls with Kevin Simpson, featuring expert insights and analysis from the industry's top investment professionals. If you'd like a deeper understanding of today's markets, this is the show for you.
All right, welcome everyone to this episode of Covered Calls with Kevin Simpson. It's my podcast, and I'm grateful for you joining us. For those of you who don't know, or maybe a first-time viewer, I'm the Chief Investment Officer at Capital Wealth Planning. I run a large cap dividend portfolio with a covered call component. The purpose of the podcast is to try to bring together some of the greatest minds on Wall Street. And I'm so excited today to have my friend Kristin Myers join us, who I know from Yahoo Finance. We know each other from Yahoo Finance. She's a terrific reporter, a great investment advocate, investor advocate, and she is the chief editor and founder of The Balance, which is an incredible website that I've just recently come to find. And the information that you can find on this website is incredible. It's free. It's easy to understand, and it is robust. Kristin, thank you so much for coming.
Thank you. I'm not the founder of The Balance, just the editor-in-chief, just the EIC, but thank you so much for having me.
Well, you're the boss. How's that?
I like the sound of that.
So tell us a little bit about The Balance. What is it? Who are your subscribers, the customer base? Who are the primary readers? And from there, I'd love to hear about what the interests, topics, and hot items are on The Balance.
Yeah, so The Balance, or thebalance.com, is a totally free website that has tens of thousands of articles and pieces of content on honestly any financial topic that you could honestly think about, Kevin. So things like, what is a recession? Should I have a Roth IRA or a traditional IRA? How do I get started in investing? What is a budget? How do I make one? What's the best credit card for me? Whatever your financial question, essentially, that you might have, no matter where you are in life, whether you're young or you're old, we've got the answers and some educational content for you on The Balance.
Well, when you talk about the balance.com and the content, you mentioned young or old. Do you find that you have more young or old? Who is the viewership, and what does that demographic look like?
Yeah, so right now we are looking at more older millennials. So that's folks probably around 35 to 46 years of age right now that I would say are really most of our audience members at The Balance. And they've been really interested lately. It's been a very interesting time, to say the least, in the U.S. economy and also the U.S. stock market. And so they've really been interested and curious about things around inflation, economic recessions, especially trying to learn a little bit from history, and as well as oil prices. They've also been very, very interested in and have been searching a lot on our site for.
When you said that demographic, it made me feel a lot better because I'm not that far away from a millennial. I thought I was until 1 second ago. But thinking about the market correction that we've been through. So the past 3 years, we had a massive super cycle. Everything went up, whether it was a stock, a cryptocurrency, an NFT. You could throw a dart pretty much at anything. And it seemed like there was a free money trade to be had anywhere. Of course, there was a little bit of a hiccup in early 2020 where we had a 35% market correction, but it recovered so quickly. It's almost like we didn't get a chance to appreciate what it feels like to be in a bear market or a volatile market. How are the millennials focusing on what's been happening in 2022?
You know, that is such an interesting point right there, Kevin. That blip that we almost saw in the markets, right? It like essentially tanked, quote unquote, and then just made a complete about face and just shot up, honestly, sky high. And to that point, I think for a lot of millennials, but let's just think about this. Over the last 2 years, we saw so many new investors coming to market. This is honestly the first time I think most millennials have really had this down market, this bear market test. They've never really been in the markets before where it hasn't done very well, considering that the recession happened right when a lot of millennials were graduating college. And I think they didn't probably touch investing and were a little bit afraid to touch investing for a couple of years. And so all they've ever known is the markets going from good to better to best. And now things are taking a complete about face. And I think a lot of them are asking questions like, what am I supposed to do with this portfolio? I've been investing a lot in tech and it's been treating me very, very well lately. And now we've got the NASDAQ in a bear market. And so I think a lot of them are trying to figure out how they can hedge against some of the risks that we're seeing in the market around inflation, around economic recession. And they're honestly trying to figure out what they should be doing and where they should be putting their money next. Because honestly, the party is getting a little bit sad now. The party was everywhere in the markets before, and now it's not at all.
It's a completely different market, almost like when you turn the page from 2021 to 2022, that, the hangover hit immediately and it was a completely different world. But it makes a strong case for diversification. And one of the advantages that younger people have when we go through a time period like this, and even an extended recession or a range-bound choppy market, is that it presents opportunities to really educate the power of compounding and the power of dollar cost averaging. Because all of us, when we start out and we get a 401k going, it's exciting to see it go up. But initially, as young people, we don't often have large amounts of money that it's that impactful over time. And I would always be taught, well, you really want it to stay down for a long period as you're accumulating this money and reinvesting and compounding. And when you have money is when you'd like to really see markets move. We don't always have control of when they move, but it's a great opportunity to get back into that old-fashioned basic idea that consistent investing, dollar cost averaging, and what that power of compounding can really do. Is that resonating yet, or is it still a little shell shock?
No, I think that point is it's so important, because I think this is the time when folks are really, when it comes to investing, are kind of going to have to go a little bit back to those fundamentals that you're mentioning, right? That dollar cost averaging. Now is a time that you're going to have to essentially have patience. And you're going to have to be willing and also have a little bit of stamina. You have to be able to go forward with your plan that you've put in place, because you do have the advantage of time, especially if you're that millennial investor. And you have to understand that you can have a little bit of faith that markets likely are going to go back up. So this is not the time, to scream that the sky is falling and to pull all of your money out. And this is that time that you say, okay, I might be down bad right now, but if I stay the course, I will end up better on the other side. And we are starting to see that right now. I mean, a lot of millennials, a lot of younger folks, they're buying the dip. They're seeing the red across the screen. And I don't think they're entirely afraid. I think they're viewing a lot of this as some buying opportunities. So it does seem as if a lot of what we've been saying, or a lot of what we've been educating people on in terms of investing, has somewhat started to stick. And that folks are saying, okay, it's fine if my retirement portfolio doesn't look too hot right now. And I always say to everyone, stop looking at your 401k. Stop looking at your 401k when the markets are not doing well. That's not the time to obsess about the retirement portfolio. But they're saying, okay, it's not doing so well right now, but I'm not retiring for another 32 years, 30 years, 25 years. So it's okay. I've got time. I'm just going to keep putting that money in. I'm going to keep continuing to stay the course. I'm going to remain patient. And I'm going to continue to exercise some of those lessons that I've been learning.
I didn't have the luxury of having the balance.com when the bubble burst in 1999 into 2000. I think I was already old then, but the internet wasn't that old. So we didn't have resources like yours to help navigate it. But buying a dip is a strategy that has worked so easily and quickly in what became very sharp V-shaped recoveries over the past few years. If we're in store for a more stretched out bottoming process, which is my thesis, that markets bottom over time, especially after 32 years of deflation, 32 years of decreasing interest rates. And now all of a sudden, for the first time, we've got rising interest rates. We have inflation peaking at 40-year highs. It's probably affecting fixed income, bond prices, and so many other aspects of our lives, not the least of which are mortgage rates. But this idea that we're in this for a little bit longer creates opportunities not to buy the dip to look at it as a trade, but to take advantage and buy the dip and look at it as a long-term investment. It's hard to do. It's easy to say we want to sell high and buy low, but sometimes the emotional aspect is you want to run away from things that are underperforming and you want to chase that thing that looks like it's really doing well. And that has a tendency sometimes to get you into trouble because you're constantly moving against the grain when we want to be doing the opposite. And doing the opposite is hard. It's really hard to buy when everyone else is selling. And it's hard to sell when everyone else is buying. But those are probably some of the great lessons that people can learn on your site.
Well, as Warren Buffett always says, you got to get greedy when others are fearful and fearful when others are greedy. And it's hard to do that. It is honestly very hard to do that, to do what you're saying. But yeah, I mean, on our site, we honestly do have a lot of resources. I mean, we're writing things and teaching people about things like I bonds. I never thought last year that I was going to be getting this many questions about I bonds. It's not exactly as sexy a financial topic as some of the other things that we've talked about, that you and I have even discussed previously when we talk about markets. But I mean, it's clear that people are interested in making sure that even if it's not sexy, that it does work in their portfolio. But I think that's the point here, that we really need to kind of hammer home for so many investors. What got you here might not always get you there next. And yes, while some of these other stocks, some of the tech stocks, some of the high growth stocks might have been really exciting over the last 2 years, they're not necessarily going to help out your portfolio over the next couple of years. And I think, again, once we see some of the risk that some of these stocks have had, some of these companies have had in portfolios, it makes everyone take a little bit of a step back and actually assess what's going on in their portfolio, if there is long-term potential for some of these companies. Because I think for so long, or for at least a couple of years, there was a lot of almost gambling happening in the markets. I mean, and a lot of people think that the stock market is gambling already. A lot of people that are afraid of investing already view it as gambling. But I think truly there was almost some outright gambling that was happening. People are seeing returns of in excess of 100%, and they think that that's what their return ought to be. And you just kind of have to return back to some of those basics and fundamentals and say, if my portfolio is getting me a return of 10% every single year, right, the average S&P 500 return, then I'm doing well, you know. And maybe I need to pull out of some of those tech stocks and go more over to the utilities, or maybe I need to really determine if this is a company that I think is going to continue to do well over the next 5 years, 10 years, 15 years. And it's fine if it's down, therefore 20% right now, because I have faith in it long term. I think these are all questions that especially millennials are really starting to ask. New investors are really starting to ask. And as I mentioned, I mean, to plug the balance again, but we do have, honestly, a lot of the resources and articles there available to answer some of those questions.
Well, I spent time on the site, and I could have been more impressed. If I'm able to navigate it, you know, the least tech savvy person on the planet, then others are going to be able to do so. So I'm going to pivot away from my, you know, hope and dream that I was nearly a millennial, show my age, and put on my professorial hat, because although I've been only doing this for 30 years, I've followed the markets for a long time. And everything you describe about these recent bull runs over the past 3 years, they are so reminiscent of what we had in 1999. And I got in the business in 92, so it wasn't my first experience, but everyone in 1999 was like, what are you talking about? Like this, the assumption was that it's normal that you'd get these high double and potentially triple digit returns. And I write covered calls. So you can imagine how challenging that is in a strong surging market. And I'll tell you a funny story, but I'll change the person's name. So there was a person that was associated with me that I would write covered calls for. And I don't remember if the stock was JDSU Uniphase or EMC or, you know, one of these really high flyers at the time. But I had written a covered call, and I'll just think it and pretend it was JDS Uniphase. And I wrote it 30% out of the money. So with a covered call, you're able to capture some, but not all of the potential upside of a stock's move. Mm-hmm. And when you're selling a covered call, it's going to get called at that strike price. So I wrote a call 30% higher than where it was trading. And of course, within like 2 weeks, the stock went through that, got called away. And he's screaming livid that the profit was only a 30% profit, forgetting the call premium, that I had let the stock get called. And I'm like, Kenny, what are you talking about? You just made 30%, like 2 days. He's like, yeah, but my wife still has the stock and she's up 90. I said, you don't even know what JDS Uniphase is. You can't spell it. I doubt you can even tell me what the symbol is, let alone what they do. But that was the life that we were living in 1999. Not that dissimilar than what we were in now. But what I always did back then, and I had a client scream at me, also I'll change her name and call her Margie, but I put her in Merck, right? So, and she was just so mad that Merck was the stock that I made this investment in. By the way, I own Merck today in my portfolios. So, you know, Merck wasn't sexy enough. It wasn't a momentum stock. But if you own stocks that have cash on cash, if they pay dividends, if they actually make money, they have a good chance of staying around, and they have a good chance of making returns over a long period of time. You mentioned a second ago, a 10% return. You're quoting a famous Harvard study that goes back to the 30s. And it says, if you invest in the stock market, you can average about 10% a year. That's what you should expect, which is why we all invest in the stock market. It's great if we get 100, but 10% is pretty cool. The best part of that study, Kristin, is 40% of the returns, 40% of that 10% is dividends and distributions reinvested. So if we can start resetting some of the concept now of asset allocation and diversification, it's still have fun, you can still speculate. But if you start building some of the old school stocks, maybe not I bonds and maybe Merck, but having a little bit of that in your portfolio as well, so it's balanced over time, it's that compounding effect that builds true wealth. And I know tons and tons of exceptionally wealthy people, like seriously wealthy investors. And I don't know any, like zero, that were successful wealthy traders. I know one, successful wealthy traders, like seriously one.
You know what I love about the markets is that it's a great place to be if you're someone like me, which is, I mean, I don't often admit this, but sometimes lazy.
I doubt that, but maybe from the investment standpoint.
But think about it though. This is your stock and trade. This is what you do every single day. But for a lot of folks that are out there, a lot of people that want to make money in the markets, they have no interest in, reading through quarterly earnings of all these companies that they're invested in. They don't really care. They just want to make a little bit more money than they had yesterday, and they want to make more money tomorrow than they did today. That's essentially it. And I think the market, if you are willing to leave some of that emotion aside, if you're willing to say, I just need to be almost a little bit like the tortoise and less like the hare, right? You are going to end up doing very well over time. Because as we've seen with some of these really big swings that people have taken in the markets, they've got some really big misses. And it's great when you feel like you're up 90% one day and you might, almost turn up your nose at someone who's only made that 30% return, as you're mentioning. But then what happens when they're down 90%? Because they weren't willing to essentially mitigate some of that risk. And it is so funny because where else in life can you be given a 30% of return on your money and you're complaining you didn't get more? If someone walked up to you on the street, if you gave them $100 and they gave you back 110, for nothing, that you did nothing, would you turn to them and say, why didn't you give me 150? You wouldn't. You would just be happy.
I don't talk to people on the street.
You'd just be happy that you got the extra free cash. and only I think in these really good times, as you were describing, history repeating itself, it's only in these good times that people start saying 10% is not good enough, 20%, 30% is not good enough. I need to be making 150% returns. And that's great, as long as that train continues to run, but it doesn't stay on the rails for very long.
If companies don't make money, the stock prices eventually are reflective of that. So a lot of these companies in 1999 went by the wayside completely, and all crashed in March of 2000. And we saw the same thing just over the past few years. Like, how many stocks can you think of off the top of your head that are 50, 60, 70, 80% off their highs? Some of them really, really popular mainstream companies. But it's all about earnings. And if you've got a company that's boring and old and ugly but makes money, you're going to do pretty well over time. And it's just your tortoise versus the hare analogy. So I think it's fun to do both. I mean, I know you well enough to know that you're not lazy in any way, shape, or form, but you're busy working and writing and doing a million other things. So if you're a new person to investing and this is your first foray into it, and you're Generation Z, because I know what that is. Looking at index-based investing and dollar cost averaging or dividend reinvestment programs, where maybe you just identify with 3 or 4 stocks that you feel really comfortable with as a consumer, and you do a little bit of research up front, but you just put a little bit of money into them on a constant basis and allow them to feed upon themselves and reinvest. That is the best lesson that people can learn about investing. And then looking at speculating / gambling / trading as maybe a fun thing to do with a small portion of your portfolio, but you put your real money to work. And it doesn't matter if you're a billionaire or you have $100, it's that percentage that I'm going to allocate to something that makes sense and fundamentally will work for me over time, even at a slower pace. And then I'll have fun with a little bit, at whatever level that may be. And I feel like that might be a good lesson.
That's actually exactly what I do. My investing game totally changed once I stopped putting in money whenever I kind of remembered to. into my account, and I started actually having it automatically debited into both my 401k, and then I have an IRA, and then I had another investment account, and money is automatically debited into all of those. And if you looked at that portfolio, it wouldn't be that exciting. It's a lot of ETFs, index funds. I'm just essentially putting it in on broader based either markets or industry, and the indices or in industries. And I have one investment account that I put only like a couple $100 a month into. And that's where I play. And to your point, I'm okay with playing in that one account because I know I'm okay everywhere else. And you can still make those exciting trades, and you can still go after, do a little bit more of the quote unquote speculation. I throw money in random cryptos that I sometimes hear. I figure, oh, I'll put $50 on this, give it a whirl, let's see what happens. And then I'm not upset if I lose $50 of my money, which would have been the case if I was invested in some of the cryptos lately.
Or if you were a person that enjoyed putting very small, modest bets legally on football on a weekend. I
would
don't
do even worse at that. I would do even worse at that than I do in the markets, I think.
I don't do either. I don't gamble. I feel like anytime I tried to speculate as a younger person, it was always the coming in too late. The emotions played too big a part. But to your point specifically, you've got this allocation of a portfolio. Not that you ever want to lose all of it. That's not the intention. But if you did, the bulk of your assets are still working for you in a real methodical way and a systematic way. And I think that's really the best lesson, because even in failure in investing, and lots of people have failed over the past year watching these things tank, you learn a lot. You can't succeed without failing. And that's such an important lesson. And it also educates us on what makes sense in investing, what's really going to work over time. What are these things that we can do? I had a conversation yesterday. It's funny, you mentioned Warren Buffett a short time ago, and we were talking about Apple stock specifically. And all I ever talk about ad nauseum is dividend, cash on cash. I want return of shareholders. I want money. I want share buybacks. And they brought up Apple, and they said, it's funny you say that, because Warren Buffett, if you look at his purchase of Apple, everyone thought he was so late to that party. Like he was so late going to Apple. But the reality was he was disciplined, he was patient, and he wasn't going to invest any of his clients' money into Apple until they were in the position to return cash to shareholders. And I think that's just a wonderful lesson today, more so than ever when he took the position, because it's so old, it's so boring, it's so crazy that you want companies to make money. But look at how much he's made on that Apple since he took that position. And I've mentioned 1999 and 2000 way more than I should have in our conversation. But I can assure you that in 1999, there wasn't a person on the planet that was younger that didn't think that Warren Buffett in 1999 was old, over the hill, and a crazy old man whose time had passed. And today's 2022, and we're both quoting him, and his lessons are as invaluable today as ever before.
It's funny you mentioned 2000s and then the companies that aren't around anymore. I keep thinking of pets.com. As you've been mentioning that, because it was recycled not too long ago, as we saw, the IPO parade, the red carpet being rolled out for a lot of these companies that weren't profitable. Some of them I was skeptical on their future success. And as you mentioned, a lot of companies right now are not doing very well. And, it's to the point about missing the party. If a party starts at 12 noon and it goes until midnight, do you not show up just because you would have gotten there at 3? You figure, no, I've got 9 more hours of party left. And that's still good. And sure, you might not have had as many drinks or whatever as if you had gotten there a little bit earlier. But to that point, you have to be willing. And these are the questions that you have to ask yourself. And this is where I think, again, that discipline really does come into play. When you start asking the right questions about the market, about your companies that you're interested in, even about your portfolio, once you start asking those right questions, you start getting answers that help you really kind of almost ignore some of the emotions that really might be steering you in the wrong direction. And like I said, I think it is encouraging to see where a lot of, millennials is my cohort, and even Gen Zers, which is much younger.
I know all about it.
They're in their 20s. Some of them are still in their teens. I believe they're 19 to 28 or something like that. But or 26, but so they're very, very young. But they're also asking some of these questions. And I think where perhaps the one area where Warren Buffett's not going to help them, sadly, is cryptocurrency, because millennials, Gen Zers are very interested in it. Millennials are actually equally as invested in crypto as they are in stocks, a little bit over a third. And they're looking at it as actually a retirement. A third of them say that it's their retirement strategy and method. And I mean, listen, Bitcoin's been a little battered, a little bit bruised lately, but only time is going to tell if, what Warren Buffett has essentially called junk is going to actually be a very serious part of portfolios going forward.
Well, that junk was polite. Charlie Munger, I think, called it a whole lot worse. But
Yes.
there is a generational gap when you're in your 90s versus when you're in your 19s. So the prospect of Bitcoin, of cryptocurrency, of blockchain, I don't think that should be dismissed as junk or just offhand. I think it's something you have to pay really close attention to. You have to learn about, and kind of being halfway between the two ages. That's how I view it. We're invested in Goldman Sachs. We're invested in JP Morgan. They put tons of research and tons of money behind understanding the future of blockchain and the Web 3.0 and all of these applications for crypto. Whether or not it's something you want to bank your retirement on, not the approach that I would take. But I think if you're a younger person and you're learning about it and understanding it, and again, allocating a portion of your assets to it, then you can't be criticized for that. And certainly not something I would ever criticize anyone for.
No, I definitely agree. And at the end of the day, a good investment is one that gives you a return, right? So if crypto does that and gives you a decent return and can either do as well as the market is doing or exceed that, then it's a good part of your portfolio. But I do think crypto is here to stay. Digital coins are here to stay. Digital assets are here to stay. Blockchain is, of course, the technology I think is going to be very vital and pivotal moving forward, especially as we see continuous cyber hacks. And, I think a lot of the banks realized that tech was actually vital and important. I mean, how many of the big banks have we heard just in the last 5 to 10 years hiring a chief technology officer? And that was a role that they probably would have never thought that they were really going to need or have to provide some of these financial services going forward. So I agree. I don't think crypto is something that you can dismiss. I was surprised to see that it was going to be a leg in the stool of retirement. But hey, I mean, I think it might just be something we millennials might just be onto something, Kevin, and it might be where we go in the future.
I criticize nothing having to do with it. I just don't think it should be the bulk of the retirement yet. And it's always this plain old thesis I have. If you can explain to me why it's a good investment, then you should invest in it. If you have trouble explaining why it's a good investment, then maybe you should be careful as to how much you apply to it, because then you're speculating. Mm-hmm. And it's fun to speculate, and you have to speculate, especially when you're young. If you're not going to speculate when you're young, when are you going to do it? So we're big proponents, and we love having crypto experts come on this show and talk to us and teach us about it. And I'm learning more and more every day. So I'm not in the Charlie Munger camp by any means.
I'm glad to hear. I'm not either. I
don't own any crypto, but I'm excited to learn more about it.
Well, if you want to learn more, you can always come over to the Balance. We'll teach you a little bit more about crypto.
See, you know how to take that. I am so happy that you were able to join us today. I've missed talking with you. This is awesome. You have an incredible website. There's so much information. I'm learning every day off of it, and others can. The fact that you don't charge us is wonderful. I hope it stays that way for a little bit longer. But anything we can do to help you, anyone at thebalance.com. Thank you so much for joining us. You brought a lot to the table today, and we look forward to having you back again.
Thanks so much, Kevin.
This message does not constitute an offer to sell or a solicitation of an offer to purchase securities through CWP Advisory Services. Investments are not guaranteed and involves risk of loss. The views and opinions expressed in this message are those of investment professionals made at the time this content was recorded, are not necessarily the views and opinions of CWP, and may change in time without notification. For additional information about CWP, visit CWP's or the SEC's website for a copy of our ADV disclosure brochure and Form CRS.